Good morning. It is wonderful to be back after traveling the nation for so long. I really appreciate you guys joining me this Friday to kind of give you a breakdown of what's going on in real estate. So I have some really cool stuff planned for today. I'm going to end with a market analysis. I'm going to show you guys exactly how interest rates work as far as a consumer. How do you price interest rates? We're also going to have a special guest come on here. I'm trying to do something different on the lives to where a member of our Discord community, just a random member, is going to come on to the live and share with you guys his perspective on what's going on in the market. I'm really looking forward to that. I really feel like we're going to be able to grow the community at Real Estate Mindset, and that no matter what happens, we're going to be empowered and making great decisions when purchasing real estate. There's so much, things are so much more important than narrative. I see Trey just logged on. I see you, Trey. So I want to start by going into some breaking news on what's moving the markets this morning. But real quick, you guys, I want to just say good morning. There's Jeff. Oh my gosh, there's Christy. Man, I missed you guys. Volvo, Sheldon, Florida, Beach Bum. Thank you, Jeff. I appreciate it. So let me go into and show you guys exactly what's going on in the market, because we've had massive, I need to change my title because now interest rates are going to shoot up. Take a look at what's moving the markets right now, you guys. So as of this morning, we have a job report that came out. The U.S. economy added 353,000 jobs in January. Now that's much better than expected by almost double. Okay, so again, if you thought the Federal Reserve was going to cut interest rates this month or next month, that's probably not going to happen. So just FYI on that. Now, where I really want to start, guys, is I'm going to start by jumping into our first video. And this is a clip of Jerome Powell essentially saying there is going to be no rate cuts, this March, which is, really, really good stuff. So if you guys can, let me know that the audio is okay. And we're going to get started on that right now. Let me kind of cue this up real quick. Got the video right here. And again, you guys, let me know that the audio is okay, but here's our first video.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call it, when you ask me about in the near term, I'm hearing that as March. I would say, I don't think that's probably not the most likely case, or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be one?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happen, that would cause us to go faster and sooner. And that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Okay, guys, let me know if it's still echoing. I saw your messages down there about the echo. That's not what I want. We don't want no echoes. Obviously, that would suck. But just to recap, guys, and again, that was the first video. That was Jerome Powell yesterday. He's basically saying, unless, in so many words, what I interpreted that, unless there is a labor market softening, higher unemployment, they're not going to cut in March. And what happened this morning? The jobs are double the expectations of the market. So Again, and we're going to look at the CME, we're going to look at the market, but they're now pricing in first rate cuts later on in the year, which is something that we've been following a lot. Charles, I see you, brother. You're a little bit early. I got Charles here already. He's going to come in part of the community. But before I go into that, guys, I want to go over what is going on with interest rates right now. We have a tremendous amount of movement with interest rates. And if you guys can, let me know that the audio was okay there. Not happy about the lack of quality audio. So let me know that it's okay. I see you, Charles. That's so funny. I see Charles. Anyways, let's go into this right now. So what's happening, you guys? The 10-year has absolutely skyrocketed. The name of this video is mortgage rates were plummeting because they were plummeting 32 basis points over the last week. However, as you can see here, that is going to change today because what happened is after those job numbers came out, look at the spike in the 10-year. It went from 3.88% all the way to 4%. Now, that's a 12 basis point increase since the job numbers came out. But again, we were sitting at 3.88. That was 26 basis points lower than about a week ago. But again, that has completely reversed. You guys are saying the echo is gone. But when I play the video, let me know the echo is gone. Massive, massive movements right now, you guys, in that 10-year. Obviously, this tracks mortgage rates. So that's why you see mortgage rates go up and down without the Fed doing anything. So the Federal Reserve hasn't cut or increased rates in a long time, and yet massive, massive volatility with mortgage rates sitting, again, the 10-year sitting at 4%. So let's go to the next thing right now, you guys, which is the 2-year. Now, this is the shorter end. You guys can see the shorter end, which is more of a liquidity zapper. That 10-year is going to crush the economy. And obviously, we're still experiencing lag effects. That's one of the big things people are watching is like, when will the lag effects start crippling labor market and economy? But as far as the liquidity zapper, that's the 2-year right now. That's yielding 4.349%. So that's holding pretty much consistently the whole time. But take a look at the 30-year fixed rate mortgages. So again, this is going to change today, but we're sitting at the start of today, 6.63%. And I want you guys to understand something very, very important. This is why I'm really covering mortgage rates. It's very important as a consumer to shop your mortgage rate, okay? Because normally you're going to get a better mortgage rate normally if you go through a broker versus a direct lender, because if you go through a direct lender, normally their cost to operate is much higher than a broker, and therefore they pass that expense on to the consumer. But what's very interesting, guys, is, and this is really I want to point out, a lot of people are being like so optimistic right now, but if you look at year over year, we're elevated. So this time last year, we were at almost 5% in the 5%. We were sitting at 6.04% 1 year ago. So I hear all of this noise. Oh my God, buying demand is coming back. Demand is coming back. But the reality is we are 59 basis points higher than we were this time last year. So interest rates are way higher right now compared to last year. And honestly, this is going to change. So probably when this updates today, you're going to be seeing interest rates probably near 6.7 to 6.75. Check that out later today. That is going to go up, and it's going to go up significantly today. So if you're out there shopping, hopefully you locked your rate in as the rates were going low. I constantly get questions, when should I lock my rate? When should I lock my rate? Now, the reality is, that depends, right? I like to play like downward trajectory and then upward trajectories as far as interest rates. So again, interest rates sitting at 6.63. That is going to go down later today. Now take a look at demand, you guys. So here's the data as far as demand, because something we constantly talk about in our, I think I see why I'm getting a echo. Okay. So in our Discord, we're constantly talking about demand, at least comic lovers constantly talking about demand. I'm going to do a separate report on this, but let's look at the actual data for demand. So starting with mortgage purchase applications, that's down 20% year over year. So we have higher interest rates significantly. I would say 60 basis points is a lot higher than we were last year. Demand for mortgage purchase applications is down 20% from last year. So where's this increase in demand? And then look at Redfin home buying demand down 17% year over year and down 3% from a month earlier. And that's not just those things. Look at interest online. Interest online, or Google Homes for Sale searches, is also down 13%, up 25% from a month earlier. So as of January 27th, but that's down again 16% year over year. So significant decrease in demand, you guys. I hope we're starting to see that. Now look at inventory. Okay, so inventory has also updated. I really like looking at this chart. So right now, again, demand is crushed, interest rates are higher, and inventory has now a 4-year high for January. If you guys can see that right there, you see this little arrow pointing there. So we are at a 4-year high. We are significantly down from where we were pre-pandemic. And I've been saying we need about 200 to 300 more existing home active units. So if we get $200,000 to $300,000, 200 to 300,000 more units of existing, we're right back up at pre-COVID. We hear stuff from NAR saying we need 4 million, 5 million houses. That's crazy. We've never had that many existing homes for sale, ever. We've never had that. We're short by 200 to 300,000. That's it. But nevertheless, you guys, demand is absolutely in the tank. It's absolutely crushed. Now, one of the things I like to do, and we'll go into the pricing. I'm going to show you guys pricing here after this. It's so important if you're a consumer that you understand interest rate pricing, because that's how loan officers and mortgage banks get paid. So you got to understand how they get paid. So as a consumer, you can have the conversation with the loan officer. But let's start with the amortization schedule, you guys. I put the average loan amount of $342,000. Today's interest rate of 6.63. That's also, remember, that's going to go up. Now, an amortization schedule is a prison of debt. Okay, that's just like a prison of debt. You guys need to understand how the amortization schedule works so you could potentially save literally $100,000 on interest. Now, I highlighted the first 5 years because I wanted to show you guys that if you paid your loan down with, on year one, if you paid it down $21,000, okay, so if you paid it down to $320,000, you guys would save 5 years on your amortization schedule, and you would save $110,000. At 6.63%, your total interest is $446,000. That means your interest rate is more like 120%. That means it's way cheaper to rent. The thing that people, and I believe in this in a normal market, is the appreciation, is the equity growth that offsets what's going out of your pocket. Plus, there's tax benefits of paying that much interest. But nevertheless, let's be realistic. The realistic interest rate is 120%. The thing is it's just front loaded with interest. So if you don't have $20,000, let's just look if you pay $400 extra a month. Okay, if you're paying $400 extra a month, only once a month, let's recalculate this, okay? So if you guys pay just $400 extra a month, you save $174,000 in interest. Y'all tracking with me? And this is the craziest thing, and I really want you guys to think about this. If you pay $400 extra a month, you just turned your loan into less than 20 years. So the advantage of doing something like that is you're not locked into a 15-year or 20-year loan. So if you have a hard month, you don't have to make an extra $400 payment. But if you do make an extra $400 payment, you save so much money in over 10 years. Do y'all see the magic here? 19 years and 10 months to pay that 30-year loan off. $174,000 in interest. Are you joking me? Do y'all see how important it is? So if you're getting anything here, and I see you, Charles, you're still early, brother. If you're getting anything from these videos, please understand the game. Understand the game of money, right? Because this is come on, guys. This is they're making crazy amounts of money off of you. So please don't be blinded by that. Now I want to show you guys exactly how interest rates work. Okay, let me just make sure that my little iPad works here. Let's see. Boom. Okay, cool. So this is everything. Okay, so if you guys are wondering, okay, what's my interest rate as a consumer? Okay, so you have to understand that right now I can still get people interest rates at 5%. I can still get that right now. What really matters is how much the pricing, okay, because we're going to price an interest rate. So how much is the pricing for the interest rate that I want? All right. And again, I'm showing you guys behind the scenes on how this works as a loan officer. So if you see the first to the left here, that first column is interest rate. We have 7%. Okay. We have 6.5% and we have 6%. Now, do you guys see these little numbers here in, I don't know what we call those. We call those quotations. Okay. We have 0, 1, and 2. So starting with the 7%, this 0 right here, okay, means there is no cost to get that interest rate. And that is referred to as par. So if you ever are wondering what par means, that means what interest rate you qualify for at no cost to you. So if there's a cost to the interest rate, remember, throw that on top of the closing cost. So again, at par means no cost. Now I'm doing this workup, as you guys can see here, based on a $250,000 loan. So say I'm a consumer, I'm like, no, I want 6.5. I'm on the phone with my loan officer and I ask, hey, how much does it cost me to get 6.5? You guys can see that there is a 1 here. So in order to get 6.5, that would cost me 1 percentage point of the loan amount, which means if I wanted 6.5%, the cost would be $2,500. I'm telling you guys right now, this is everything. This is what matters when it comes to locking your interest rate. It is the pricing that changes every day, not the interest rate, you guys, the pricing. Now, look at the last scenario. Say, you know what? I want a 6%. I've been hearing people get 6%, but based on my criteria, my credit, my income, my assets, if I want 6%, that's going to cost me 2 points. Okay, the pricing is going to cost me 2 points, which would be a total additional cost of $5,000. Okay, and that's in addition to what your closing costs are. So if you're pricing your loan, one of the things that I do as a consumer is I ask a loan officer, what's par, what's 1 point cost? And if I really want to get detailed, I'll ask a loan officer to print out the pricing schedule for me. Because there's many tiers of pricing. It usually goes by 1/8 of an interest rate change. So 6%, 6.125, 6.25, 6.375, and 6.5. And each category of those interest rates has different pricing. And as a loan officer, what I would try to do for my consumers is try to find breaks in pricing, because sometimes, and this is why you want to shop, sometimes lenders, like maybe it's Wells Fargo, not anymore though, they'll offer a special pricing to try to get more market share. So again, as a loan officer, whether or not you're a loan officer listening to this, that's what I do. And a lot of times back in the day, I can get the best pricing. Remember, that's what interest rates are, from PennyMac. So I would lock a lot of times with PennyMac. Hope that helps you guys. We're going to get it into video number 2. By the way, comment below. Did that make sense? Did you all learn something right there? I want you guys to constantly be empowering yourself. That way, no matter what happens, at least you're more empowered. Did you guys gain something from that? Did the pricing make sense? You don't want to get sold on payment. Okay, you want to see the big picture, how everything is calculated. And pricing, my friends, is a very, very important thing to understand when it comes to your rate lock and your closing costs. So let me know, comment below. I'm serious. Serious, guys, you guys are hurting my feelings. Did y'all learn something right there? We're going to go on to our next video now. And our next video is, and I really hope it doesn't echo. I'm going to be so disappointed if this echoes. I'll probably start crying if it echoes. But, this is going to go into the fact that we're probably not going to get any rate cuts in March. Okay, so we're going to go back into the rate cuts. We're going to go from this. We're going to listen to the suits now, talk about this. And if you guys can, again, please let me know that the audio is okay. Charles, I'll be with you soon.
The bigger picture backdrop for the economy is one of positivity. Generally speaking, the jobs market is still good. Inflation seems to be something that some folks are declaring victory over. So does that mean the Fed can wait a little bit longer before it embarks on its rate cutting campaign, if that were to happen?
Yeah, absolutely. So I will say I agree with you. The economy is looking reasonably healthy. I will say we've been in the no recession, soft landing camp for a long time, since the first quarter of 2022, and it looks like that's playing out. I do think, though, there's some cautionary tales about when the Fed is going to cut. The market has gone from thinking no cut in March to thinking more than a full cut priced in, and now back to less than 50-50. I think the last GDP print, the retail sales report for December, are all cautionary tales for the market that there still is some momentum left in this economy. And so the Fed, they're going to have this internal debate about when to cut. Our baseline is June. I can see an argument that it might slip to earlier, maybe the May meeting, but we think the next couple of prints give the Fed a reason to sit on their hands just a bit longer.
And Seth, if you take a look at the reasons why you laid out, there's at least a little bit of leash, a little bit of latitude that the Fed can take with regard to this. What is the case to be made of why the Fed would want to move ahead that timetable and cut rates sooner? Is there any reason why they would? Why is the market thinking that they should?
I think if I was going to make that argument, it would have to be for one of two reasons. One, there are plenty of people still in the market who thinks the U.S. economy is going to go into recession. And to be honest, you cannot rule that out. And so part of the market pricing is probability weighting on different scenarios. And so in the event that our baseline view is wrong and the economy does slump early in the year, then maybe they cut more. And that's part of what's reflected in market pricing. I think the other sort of more direct channel, though, is inflation has come down. It's come down a lot. It's come down a lot more than the Fed was expecting. And so if the committee could get comfortable that inflation has not only come down a lot, but is no longer a threat, then maybe they move forward the rate cuts just to make sure that they aren't the ones that cause any damage to the economy. It's not our baseline view, but I could see someone making that argument.
Seth, I understand that you really think it's time for the Fed to change the language around its expectations for inflation.
Well, I think they've done a reasonably good job sort of updating a bit over time the language that they have in their post-meeting statement. They said that inflation's come down, but it's still elevated. At some point, once we get the run rate on inflation, the 12-month change back down below 2.5%, the month-on-month run rate for core PCE has actually been quite low recently. We think it'll tick back up. But at some point, they're going to have to confront that question. How long do they keep saying that inflation is elevated? You know, again, in my experience, I spent 15 years at the Fed, part of it writing drafts of those statements. I think they'll wait as long as they can, make as few changes to the statements as they have to until the data basically compel them to make that.
All righty, then let me just cue this up. So that's the first video. Don't be expecting rate cuts. And real quick, and Charles, I see you, Charles. I'm gonna bring Charles on in a minute, but I wanna go over to liquidity. And real quick, I just wanted to bring Dan up again. Dan, here's my issue with you, brother. I mean, you've been trolling us for like a year. You've said, what, 10 times that this is the last time you commenting. And I don't mean to be mean, brother. It's just the reason I don't wanna work with you is on one of your live podcasts, I heard you tell people they better hurry up and buy because you're going to get stuck trapped renting. Rent goes up 15%. And then the thing that I make, like if you guys go to his channel, like seriously, go to his channel and check this out. I could be wrong, but I've been trying to warn him to, update the compliance on his channel because the CFPB, as far as I know, fines people like him that don't have proper disclosures on their channel when you have a link leading to your loan application. So he's obviously generating leads. Dan generates leads and do your thing. So he's a hyper bull and that's fine. But that's my issue, Dan. I just want to let you know that. It's not like I'm afraid to talk to you. It's just I don't want to waste my time, man. You're not even listening to what I'm saying. So I don't believe that we're friends. If you want to keep coming on and trolling, that's fine, man. I'm not going to delete your comments, but I wanted to be clear that you should probably be careful with how you're operating. And if anyone's from the CFPB, prove me wrong. Go to his channel, look at his links to the loan application part, and tell me that's not a CFPB violation. I mean, the point is if you're going to generate leads on YouTube, that's fine, but be compliant, right? And don't say people are going to get trapped renting. What you should say, Dan, is wedge, cash flow. I have a free home buying course. The decision is up to you. Have, the proper expectations and things like that. So that's my gripe with him. And I'm almost there, Charles. I'm almost there. We're going to go into the liquidity part. I think it's important to watch the money, you guys. So we're going to do that. And then we're going to do an interview with one of our people from Discord, our community Discord. So let me tee this up, starting with we're going to go into the 10 and the 2 inversion. Okay, let's go here. I apologize for that. So here is the 10 and the 2 inversion. This is the massive economic indicator. And really, the bulls can't really celebrate until this is uninverted. And we have this quote unquote soft landing, which is basically the recession isn't going to hit us. A soft landing is no recession. Let's be honest, which is another word for saying no unemployment, because recession, unemployment, kind of the same thing. You guys, we are still inverted. And really what's the interesting thing is, which means the 2-year treasury is higher than the 10-year treasury. We've been inverted for approximately 19 months. I believe this is the 3rd longest in history we've been inverted prior to reversion. So we've been in this sucker for about 19 months. Now, I think about this constantly, and really it makes sense because we have more money to be burnt out of the system. We had record amounts of PPP, direct checking stimulus for consumers, but nevertheless, it is taking a long time. Okay. Normally when this reverts, we go into recession. Now there's a bull steepening happening and a bear steepening happening. Now the bear steepening is what we saw a little bit earlier this year, and that would indicate a strong economy, meaning the economy is strong so we can handle high interest rates. When the economy is weak, we have a bull steepening, which means the short end of the yield goes up past the longer end of the yield, and that would indicate a weak economy. Because remember, you guys, if we really do have a strong economy, we can handle the higher interest rates. Right now, we're not really able to handle that per se. At least most of the people on the bottom can feel that. We don't see it in the job market. Obviously, we see full-time jobs being lost. Nevertheless, you guys, we are 33 basis point inverted. So what this is indicating from basically, if you look at this from a historical aspect, this is indicating we're not going to go into recession till the soonest Q4 of this year, maybe Q3, a technical recession. So the can has been successfully kicked down the road. Let's really jump into liquidity. And let me show you guys what's going on as far as liquidity as well. Charles, I'm going to get to you after this. Now, starting with what's propping up the market. This is a big one, you guys. This one hit me by surprise. This was like a slap in the face to me. I'm like, oh my God, look at all this money. We still have money in the market. There's still money in the market, and that's why people debate the hyperinflation narrative so much. So it's basically either the economy is going to bust or we're going to be stuck in this situation in a hyper supply situation. But the reverse repo market is plummeting. This is like the excess money that was printed. Okay, so that is really, really going down. We're almost under $500 billion right now. So we were just at 2.3 trillion back in March. So less than 1 year, and we're only at 500,000. So a lot of people think the economy is really going to fall apart once this money is gone, and it is plummeting. So this is, if you want to watch the money, you guys, that's one big area to watch. Reverse repo market, almost under 500 billion. Really, really cool to see that. But that is propping things up. And it sucks. It means that we have to be waiting and be patient. And really, there's a lot of probabilities. Now, let's go to the next one. This is okay. So here's the other form of liquidity. Everyone's like, oh, we can't pay our bills. We can't pay our bills. But yeah, we can. We got, $841 billion in the Treasury General account. And that's been going up. So that was actually down December 13th to 658. So this has gone up to almost $200 billion. Is that crazy to you guys? In about a month and a half. So that's gone up 200 billion in about a month and a half. So they're getting money elsewhere. I don't want to speculate where that's coming from, probably treasury sales and things like that. But this is another source of the money. So again, we have the reverse repo market we want to pay attention to, and we have the Treasury General account. But on top of that, remember this, okay? Remember what, actually, this is the money. Okay, so here's the M2 money supply. Now, I wanted to point out, since about October, say the beginning of November, the money supply stopped going sideways and actually started going up. And this is probably why we see the economy so strong. The economy is so strong right now. It's the money supply is going up. So the quantitative tightening, maybe we need to stay elevated for a little bit longer. We don't have enough job loss, and I don't want people to lose their job, but money's being kicked in back to the market. So maybe it's geopolitical. I don't want to go into the wars, but money is being kicked back into the market. And that's not good. So if you want to, again, watch the money come in and out of the market, watch that M2 money supply, which again, for the last few months, that's been going up. And that's the reality. Now let's look at this. This is quantitative tightening, okay? If you guys want to know what quantitative tightening is, it's, let's just say, mortgage-backed securities. Quantitative easing, mortgage-backed securities for the sake of argument. It's not necessarily the Federal Reserve raising or lowering the federal funds rate, which is like the one-day interest rate. It's the mortgage-backed securities. Now, a lot of people, this is basically giving the ability to lend, right? So this helps lenders lend on mortgages, mortgage-backed securities. This is going down, but it's not going down at the pace that we were promised. What we're seeing here is this is the balance sheet for mortgage-backed securities owned by basically the Fed. And you see it is going down, but they are not selling it because essentially they can't sell it because no one wants it because we have 5% yields on treasuries. And meanwhile, these MBSs may be yielding 3%. So it doesn't make sense for people to buy this. Therefore, they're letting it roll off, which means either selling property and the loan's paid off or refinancing property and the loan is paid off. But this is good. Okay, so you can actually say that the Federal Reserve purchasing mortgage-backed securities is one reason why interest rates went so low. And you can see the purchasing here. So right before the lockdown, they were kind of letting it roll off their balance sheet. So that's a form of quantitative tightening. Y'all remember that? So we kind of had that quantitative tightening, and then boom, lockdowns, and then spike, bam, look at this. And this is what helped to create the golden handcuff effect. Now, here's some good news. And then I'm going to get to my man, Charles. Sorry, thank you for your patience, Charles. I see you, Mark. What's up, Mark? Now, here's the good news, you guys. Okay. So you remember me talking about the bank bailout, right? The bank bailout in March of 2023. They created the buy the F put, okay? Or rather, bank term funding program. Now, this is the debate with the Fed put, which means that the Fed is just going to bail you out if, well, not us, I'm sorry. Not us. They're not going to bail us out. They're going to bail out rich and elites at our expense. Y'all get that now, right? You see how that works? It's kind of starting to make more sense now. But the beautiful thing is this bank term funding program that we're paying for, by the way, that's preventing banks from going into failure, is ending, as you can see here, March 12th, I think. Let me see. I'm sorry, March 11th. Okay, and let me read this. On January 24th, the Federal Reserve Board announced the Bank Term Funding Program will cease making new loans as scheduled on March 11th, 2024. This is great because that's a liquidity injection. So when the banks are suffering, they could just trade their assets and get it at par for a 10 basis point fee. So if they're getting killed on hold to maturity like treasuries, like what happened with Silicon Valley Bank, they can trade those assets, quote unquote, assets into the bank term funding window. This is BS. This has prevented a bust from happening. This has reversed the deflationary crisis that was happening at the beginning of 2023 and the end of 2022. It's this right here. It's called the Bank Term Funding Program. So thank goodness they're going to end that, according to this, March 11th, 2024. So again, let's reflect one more time. This bank term funding program is ending. Okay, that's going to help reverse liquidity. Mortgage-backed securities are also going down, so we have help with the liquidity there. We have the reverse repo market right here also plummeting, and as well as the moratoriums ending. So one more thing real quick, guys. Let's see what the market is pricing in, and then I'm going to get some perspective from Charles. So here's See Me Fed Watch. Now, what have we been celebrating for the last year? Charles, I see you down there. You probably can answer this. I have been trying to say we need to get to June. If we can get to June without any of these little baby electoral rate cuts, we should be okay. And thank God that's now the market's starting to price that in again. The market was expecting a rate cut, like 6 to 7 rate cuts. That's flipped. Okay, so that's flipped based on what Jerome Powell has said yesterday and the job numbers today. And you guys can see 63% chance no rate cut in March. 63% chance no rate cut in March. Isn't that great? Look at May. So they're saying May. This is good, man. They're saying May, 70% likelihood of the first rate cut. So market's now saying 70% likelihood first rate cut in May. This is very, very good because we need to stay ahead of the spring home buying season, which they did not do last year. They did not do that last year. Instead of that, unfortunately, rates went down and home buying right in the front of home buying season, and the market rebounded sharply. So I'm going to bring on my boy now. Bring on Charles. Just wanted to timestamp this real quick. Charles, I'm going to bring you on, buddy. Let me get my, and Charles is, again, he's part of our community. I just want you guys to know we do have a community. It's free. You don't have to pay anything. And we do that so we can all grow together. And I'm going to bring in Charles, again, Discord group. Let me bring you in, buddy. Charles, can you hear me?
Yeah, I can hear you. How's my audio?
Your audio is good, man. Your picture's pretty decent as well. How you doing, man?
Good. Thanks for having me on, Travis.
Of course, brother. So a couple things Raymond's not going to be able to come on today. I wanted you to talk because, Charles, one of the things that is really important to me is that I don't lead people off a cliff of financial suicide, right? So I want people to understand that we have a community. Once the film stops, once the video ends, we're trying to put a community together where we're full of people that have both perspectives, bullish perspective and bearish perspective. But the great thing about our Discord community is we're respectful. We're respectful about it. Like comic lovers always like, I agree with all these things, but hyperinflation, right? And here's why. So I think it's a great community to sharpen ourselves up. Obviously, we're sharing a lot of data, and you've been a big part of that, Charles. So, can you start by just telling the viewers what and then I'm going to get into your rental portfolio, okay? And we'll talk about the rental market. But can you tell the viewers, what your thoughts are on us trying to build a community offline for free in the Discord group? Is that something that you like or hate?
No, the Discord group's great. You get a lot of different feedback. I see Raymond and Trey and a few other familiar faces on Discord are also on the live chat right now. I think it's good. I mean, if you can't, I kind of look at it this way: it's real time feedback. Everyone has different perspectives. Everyone's market's different, but we're getting a lot of bounce back, and it's not an open ended yes or no answer. There's a lot of complication. People are bringing up real life scenarios, and we can all kind of use it to bounce back as a sounding board. So otherwise, we only know what we know, right? So everyone else is giving us perspectives like, hey, I'm out there in the market shopping, looking at every day. This is what I see. And I'm like, well, what about this? And have you thought about this perspective? If you were the seller, why would you sell? And you gotta understand like the both sides of it. Everyone wants lower house prices, but at the same time, no one wants to sell. So it's kind of a catch, right now it's kind of a Mexican standoff where everyone's kind of staring at each other, waiting for see which side makes the first move. And so I think the Discord group's great. It's great for us to kind of feedback and try to help each other and help people both give advice, encouragement, and also discourage people or advise people not to make a bad decision that could really set them back financially for years.
Yeah, man. Hey, and to me, what's important, Charles, is that we have a voice. And to me, also, what's important is I don't want people to think that I'm above them. I am perfectly fine being normal. In fact, I think I'm winning when I'm just a normal person. I want to be humble, and I need to check myself with the comments, man. I've taken a little bit of break back on the comments because I got burnt out. Maybe had a little bit of a breakdown, and I started like trolling the trolls back, and that was a huge mistake. So you guys help keep me grounded. I'm trying to be, I love people, man. It's just, when someone pushes me, sometimes I push back. It's just how I was raised. It's something I've been working with. And by the way, I got cussed out by a Pulte rep on this journey. Like this dude was like tatted, looked like he was on roid rage. He's like, get the F out of here. Da, 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 da. So, I mean, it's crazy out there, but here's the thing I want to talk to you about. I think you have a lot you can say in this regard based on your experience. Now, there's a premise that because of the golden handcuff effect that people are going to convert their primary residence into a rental property, like what I did. I own a rental property. I didn't buy it to become a landlord. I had to move based on personal situations, and I didn't sell. Although, honestly, brother, I may sell it come June. If the market hasn't crashed and it's still fairly strong, I'm selling my rental because it's just too top heavy, and I'm going to be done with it. But the thing is people don't realize how much being a landlord absolutely sucks. I have too big a heart for it. I don't want to judge people. My tenants are not paying right now. They haven't paid since January 1st. So, being a landlord can really, really suck. Can you tell the viewers about your experiences being a landlord and whether or not your tenants are still paying?
Yeah, I mean, 100% agree with you, Travis. I have a very similar situation right now with it's my primary residence in Las Vegas, and currently they're behind, even before January. They're a few months behind. Family, everything, it pulls at your heartstrings. You really want to take the higher road and do what you can for them. At the same time, you can't be left holding the bag. So, but like most people, I purchased a home with the mindset like I was gonna live there for, it's not forever, but at least for a good amount of time. And of course, life happens, pandemics happen, etc. You may have to relocate, jobs have to relocate. So you have to keep that flexibility. And it's really expensive to sell a home. First and foremost, it's not liquid. It's not, you can pull cash out, but to sell a home, it costs 5 to 10% depending on the market and how you approach things. But it costs a lot of money. So if you're selling a $500,000 house, it may cost you 30 to 50 grand right off the bat. So keep that in mind. And so that's when I relocated myself personally, I had to remember to do that, and I converted my home into a rental. And that's kind of where I kind of get it. So now I'm kind of like accidentally a landlord, not by intention. And it's tough when you're a small mom and pop property manager, essentially, where you're not really, can't really give this to someone else. It's not really worth it to find a property manager. At the same time, it's headache dealing with people on a personal relationship on this. You're trying to make business decisions, but also the emotional aspect definitely plays a factor.
So Charles, I've seen in my own rental market here, it was up until about 2 weeks ago, it was melting down. Rent was declining, inventory was exploding. Now, I'll be honest, man, over the last couple of weeks, I've seen a bit of a shift in that. Still a ton of inventory, rental still down, but like not as crazy as it was 2 weeks ago. From your perspective, and I believe you're in the Atlanta area, are you seeing directly the rental market start to soften?
It's definitely softening in certain areas, and this is real estate is very hyper local, right? You want rental properties are different, uh, different sometimes a different audience, different demographic.
Yeah.
They may not have kids, so they don't care about schools as much necessarily. They care more about bars and restaurants and entertainment options and parks. So you just kind of gauge it by that. What I've seen in like the more like I guess downtown centralized type areas with Orlando, for instance, there's actually a lot of shopping centers that they built recently. Battery, which where the Braves play, they've done a really good job in Midtown with a lot of different bars and stuff. Those markets are still really booming in terms of the rent prices. But now when you start getting out a little bit further out, where it's now you're adding a 30-minute commute, um, it's not near public transportation and so forth. Those ones would definitely be impacted more, and you'll see like people throwing out month free rent, stuff like that. No security deposit, low security deposits, that sort of thing. Back any credit type, they don't check credit, whatever. So they need to fill those vacancies. But at the high premium locations, they definitely will be very, very strict about who they accept.
Now, Charles, now that you have a better idea of the what it's like being a landlord, do you have regret?
Well, it's one of those things in life, right? Everything was working great until it wasn't, right? So like when I had great tenants before who definitely never Johnny, love you, man. You got some I saw your comment earlier. I forgot to mention you. It wasn't intentional. But anyways, sorry, I lost my train of thought. What was the question again?
That happens. It's hard, right? When the camera's rolling, Charles, it's hard to
Yeah.
keep, it's a lot harder than people think. But, I was just, do you have
Oh,
regrets? One of my regrets is I don't want to be in a position to have to evict someone. I don't want to be in a position to judge people. And honestly, man, that on top of my rental market softening, I may ditch it. It's just, to me, it's getting to the point. It's just not worth it. I can cash in on my equity. I have a 2.5% 30-year fixed on the house. But again, if the market, I'll put my money where my mouth is. I'll sell that sucker if the market rebounds this summer. You can guarantee that. And I'll take that money. I'll put it in treasuries and I'll keep waiting. So, do you have more regret? Is really,
actually, I mean, right now in the moment, yes, because I am, dealing with, and Trey, I saw your question. I have started the paperwork. I haven't had to fulfill the eviction, but I did start the eviction. Tom, I'm looking at Atlanta, but I go back and forth between Atlanta and Vegas. I was there yesterday. In fact, I just flew back last night. But I mean, there are some regrets. Initially, no regrets at all. I mean, had great tenants. When you have great tenants, I mean, the best tenant is one you never contact. You just send a bill. You never hear from them. That's kind of like ideal situation. And then the opposite side of scenario is when you become a forced debt collector essentially, and now that's definitely not nearly as much fun. So is there regrets? No, because I mean for a number of years they're helping pay my mortgage, and at that point it was great. And then obviously I benefited from the home appreciation for the last 4 or 5 years, so I can't complain about that either. So it'd be very hypocritical for me to take there's good and bad, right? So definitely benefited. Right now, as of right now, I definitely don't like it. But if I had a good tenant right now, I wouldn't be saying that. I'd be like, being a landlord is fantastic. They just send bills. I never hear from them. So,
man, I hate it.
Yeah, when you're the opposite. Now I'm like trying to track them down. They're ducking my phone calls. So,
I hate it, man. I really hate it so much. But it's just like this war against tenant versus landlord. And looking back, if I think I'm done. I think I'm done being a landlord. I just don't want it. I know we can make money. I'm netting over $1,000 a month. So it's an incredible asset, but it's just, I can't do it anymore, man. I don't want to fight with people. It's their livelihood. It's where they have children there. And I'm just not ready to be a landlord. Maybe if the market was less toxic and we weren't in QT, it's just, I see pretty bad stuff happening. And that's why I may sell. Now, are you considering selling any of your rental properties?
It is, I mean, ideally, and I am talking to my tenant right now, and he's going through, there's the child tax credit just passed. And so he's been promising me that he'll, make good once he gets that refund back. Uh, it kind of depends. I mean, I'm kind of like, I have options where I'm like playing. Johnny, it's based percentage wise. Property managers normally charge 8 to 10% of the annual rent. And so that's kind of where, and sometimes, so essentially the first month's rent, you pretty much give to them. So, but anyways, so I'm kind of playing by ear. I would love to keep the place ideally in the situation where I do have a low interest rate, like you said, and it's kind of on cruise control. I have a very nice wedge where I am cash flowing when theoretically they're paying on time. So it's one of those things where like it's an ideal situation. I don't have to force it to sell, but at the same time, because I go back and forth, if all my real estate was in the same city, it'd be a lot easier. But being multiple states, it's tough. Like I don't want to take a 4-hour flight every time if I had to go file eviction paperwork, I got to go fly out there just for that. Pain in the ass.
Now, Charles, when's the last time you purchased a property as an investment?
I bought a house here in late 2022. Where everyone I zigged where everyone zagged, right? Everyone else kind of stopped. Real estate went from you couldn't buy a house, you get outbidded by 30 people, to where the agent actually called me. I wasn't super sold on the house. The agent actually called me like, "You want to put in an offer?" And I was like, "Not really, but I don't want to insult you guys, but I'm gonna probably put an offer like 10% below listing." And they came back to me and they're like, "You want to go up? There's actually someone who's outbidding you slightly." I'm like, "No, it's okay. They can have it." And they actually said, they came back like, "Okay, you know what?" They took their number because the other group was an investor. And a lot of investment groups were kind of low. There's a really kind of shady business practice from a lot of investment companies. And I don't want to go off tangent here, but they will actually they'll put in a higher offer, outbid everyone else. And then when it gets close to closing, they'll actually go back and lowball the seller. And the seller, at that point already moved out or they relocated or whatever it is, and they're already tied up in another transaction. And they'll be like, take it or leave it. And then so that the person I bought the home from actually had that happen to him before from a different investor. And so they're reticent to do it. To my benefit, they actually took my offer because I was a person who's actually going to live in the home, and versus I'm not going to lowball them and just walk away from the earnest money deposit. So there's a lot of aspects there.
In the last question before I let you go, Charles, can you explain to the viewers what fundamentals were you using to purchase a home? Did you just purchase a random home? Did you look at cash flow? Did you look at wedge? Can you tell the viewers that process, please?
There's about 10 things I look at, and it's different for everyone, but there's things that are must-haves. Like I think the number one thing is location for real estate. You have to like the area, no matter what. You can have your dream home in terms of design, interior, looks, everything. But if it's out in a neighborhood or area you don't like, you're not going to want to stay there. And that's just the point. Is if it's too far from your work or for wherever it's really important to you, you're just not going to stay. So number one is location. Two is I would look at schools. I don't have any kids myself, but I know everyone else cares about schools. All right. So you want to hedge yourself in the future. If you want to sell it, you want to make sure you have a very safe and schools, because you may have to relocate, you may have to sell it or rent it out at some point. People care about that. So that's obviously something, it doesn't affect me necessarily at this point in my life, but definitely affects others. So keep that in mind. And then you look at the cash flow range. You look at the scenario. It's happened to me. It's happened to Travis. It may happen to a lot of you in the future. Is you may not live at the house. It will never be your forever home. Every single property I bought, I thought would be my forever home at some level, but it has not turned out to be the case. And there's a good chance. So now that I'm on my multiple purchase now, I've bought 6 homes now over my course of my last 15 years. I realize that the forever home thing is not necessarily going to happen anymore. There's a different generation. We don't live at the same place, same city for forever. And so just keep that in mind. So those are things that I found really important.
All right. And I see Trey here, but real quick, just from Jeff, and then I'll let you go, man. So Jeff is saying, we've gone back to a 1980s housing market. It's not 2008. Now, Jeff, I love you, man. And Jeff got a great deal using a love letter. I think I got like $30,000 to $60,000 off the purchase price. So if you don't think love letters work, like check yourself. They don't always work, but when they do, they work great. So it's worth it. Now, as far as the housing market, like I understand why people are saying back in the 70s and 80s, but one thing that is way different than the 70s and 80s is the consumer. So the housing market may be like the 70s and 80s, but the consumer is nothing, not even remotely comparable to the 70s and 80s from two standpoints. The wage growth was like double digits some years, and from 1970 to 1982. And the ability to save was in the double digits. There was literally some years during that period of time where people were saving 11% of their household income. Right now it's down to 3.7. And we didn't even have wage growth in 2020 and 2021 as inflation blew up, and maybe even 2022. So although I understand, like, okay, yeah, I get the housing market, it's a little tight, it's a little hot, like compared to 70s and 80s. When you look at the full picture and when you pull back and you look at the consumer, which is really running the show here, 70% of the GDP is from consumer spending. I think comparing it only to the housing market of the 70s and 80s is an error. What are your feelings when comparing the housing market to the 70s and 80s?
Well, I wasn't born yet, so but what I do remember, it was definitely more personal. When I remember going to my parents when they bought their first house. I was like 6, 7 years old. This is their first house they ever bought in the U.S. And when I went there, I do remember meeting the family. Like literally, it was like it was a real transition. Now you go to open houses, the houses are empty, they're staged. They look very cool, they look turnkey, right? But we literally they have 3 daughters, we have 2 boys. Like we're kind of like passing, 2 ships passing. We actually literally see them. It was actually a very different experience. I think Jeff is correct in like it's starting to become a little bit. We're trying to bring that back. I don't know if it's that back, but the way people kind of operate these days, there's very little interaction. Georgia is actually interesting. When you close, you actually meet the seller. The buyers and sellers actually have to meet. You actually at the closing, you actually meet. Other states, you just go to a real estate office or title office. I think it's escrow office, and you just sign documents. So that's a very cold and personal situation. But before, it used to be very kind of a warm transition. You like shake hands, like good luck. Hope you enjoy the house and you guys live here forever. And now you never met the seller. You have no idea who that person was. So.
I love it, man. So I'm gonna get this video started here, and I'll let you go. But before I go, Charles, again, thank you for your effort and just your time and your insights in our Discord group. I find it very comforting when it's not just an echo chamber, because it means like we're constantly reviewing our opinions. We're constantly like stress checking what we're going through. So, brother, from me to you, thank you for being part of that Discord. Is there anything you'd like to say to the community before I let you go, brother?
No, just follow a lot of what Travis' advice. No, it's not one size fits all. It's impossible you all have different situations, different scenarios, different obligations to take care of. Travis gave you a good foundation. All these things are applicable to anyone. So definitely keep your credit, keep the gunpowder dry, get ready for pop on any deal possible, do your local research. Those are when the deals are going to be found. At the same time, also, don't be negative, be a positive person. I think when you're a positive mindset, good things will happen to you. If you're a negative person, you know what? Everything's going to look bad. You're not going to want to do anything. You're going to miss out on things. And, that's something you control. So
I love it, man. And I would challenge the viewers, go love someone, buy some coffee, something. I mean, your mindset to love people is just so strong. So great stuff, man. I'm going to let you go, brother. And we'll talk to you next time.
All right. Thanks for having me on. Bye.
See you, brother. All right. So again, you guys go to the community Discord. Really, big shout out to Charles. It can be very scary giving your testimony on video. He's knocking it out. He's helped a lot of people. Data presentation. So check out the Discord. Let's go into our third video now, which is going to go into, there's only going to be 3 rate cuts this year. So next video, again, just saying there's only going to be 3 rate cuts. Let me tee this up for you guys. Let me know if the audio is okay, and enjoy.
Our next guest says that uncertainty about the ongoing soft landing will keep volatility elevated. Apollo Global Management Chief Economist Torsten Slok joins us now. Powell was pretty careful not to declare victory on the whole soft landing idea. Torsten, are you still not convinced?
Well, I think he was quite balanced, saying on the one hand that things are moving in the right direction. He expects inflation to continue to move in the right direction. But at the same time, he did just simply say that it's just a little bit too early to come to the conclusion that we can already begin to cut rates in March. So from that perspective, he was really telling us rates are going to stay higher for a little while longer, at least in terms of what markets have been expecting before the FOMC meeting.
I guess one of the questions then out of that is it going to be the 3 cuts that the Fed forecast will happen this year, or is it going to be the 5 that the market is forecasting?
Well, that's a very important debate, Sarah, because if you think about it, what would the economy look like if the Fed were to cut 6 times? I mean, would that be an economy that's really weak, with very weak non-farm payrolls, weak consumer spending, weak GDP? Or can they just normalize interest rates and cut rates 6 times without the risk that this might create a big rally in equities and in credit and in risky assets more broadly? So therefore, I think that they are right, that they will cut rates 3 times this year. I think the market has been getting ahead of itself with pricing in many more rate cuts, because it will be associated with a much weaker economy if they were to cut as many times as the market currently is pricing.
Well, but that's not necessarily what the market's saying. The market's saying that that inflation has been fought and won. And do you not buy the idea that if that's the case, then they have some room to be less restrictive to preserve the soft landing?
True. And if you take their framework, which they have used for decades, namely the Taylor rule, which simply would say that if inflation comes down, nominal rates can also begin to come down, and therefore real rates can stay more steady. Well, then that would certainly suggest that they should begin to cut rates, and potentially cut rates a bit more than even what they are saying. The problem with this is that that does not take into account the reality that when they do begin to cut, it does begin to raise the risk of a very significant boom in capital markets activity, in IPO activity, in M&A activity, in issuance in IG and high yield and loans. So if the Fed says green light, you can basically go ahead and take the risk that you want. That will come with the circular effect of creating a boom in housing, in wages, and therefore ultimately maybe even in the labor market. So yes, I understand what you're saying, and I agree that when inflation comes down, nominal rates should also be coming down. But the reason why I think they will proceed cautiously is because of the effects of their actions on risk-taking in financial markets.
Torsten, great chart from you this morning looking at the percentage of household debt that's fixed, almost 90%. You argue that's one reason why the transmission mechanism has been so weak. So are we really at a stage where we're just waiting for the job market to crack? And is that happening?
I mean, it depends on how much weight you want to put on the jobless claims numbers that just came out this morning. And ADP yesterday was also not particularly good. So let's see what we get with non-farm payrolls tomorrow. But if the job market starts cracking, and if we do begin to see a more significant slowdown in the labor market, then it will set off a number of chain reactions, not only with housing beginning to slow down, but certainly also we're already seeing the consumer being vulnerable. Highly levered consumers are seeing delinquency rates at high levels. You're also seeing highly levered companies are seeing default rates at high levels. So the vulnerability, and of course, the main issue is in commercial real estate. If people start losing their jobs, and therefore office space also takes another hit, then we could begin to see more of these things that we have talked so much about over the last year, with the banking sector also potentially being in trouble. So it is a more fragile slowdown that we're seeing here as a result of this. Yes, so far so good. But if the labor market does crack, then that would indeed bring along a number of other problems.
Unmute myself. Number of other problems. So you got him being a little bit more realistic. And I think it's important to understand that, again, high interest rates, good economy. So if everyone's yelling for lower interest rates, Fed bailout, come on, guys. I mean, does that mean we're in a strong economy or a weak economy? And then when we remove all of the printing from the lockdowns, I mean, it would all come crashing down right now. I mean, I think we could safely assume that. We're going to get into our new home update, and I'm going to show you guys some crazy stuff when it comes to new homes. Let me respond to a couple of these comments real quick. Now, I got a comment from Clark the Realtor. Basically saying always ask your agent for a CMA. And then MK was asking what is a CMA? And basically what a CMA is, guys, is a comparable market analysis. It's where a realtor is able to take the comparable data to give you an idea as a consumer of how much a home is worth. But I would warn you, if whether you're a realtor or not, some of the programs that run the CMA, comparable market analysis, allow you to take comparable data from subdivisions that are not in the subject property subdivision. So what I'm trying to say is the CMA is only as good as the agent. The agent can include data that's not supposed to be in there. And that's why towards the end of this video, I'm going to show you guys a market analysis. A market analysis is a more detailed form of a CMA. So, stick with you there. One more comment. You can email me. Do I have any referrals for a lender in Houston? I certainly know a whole bunch of lenders in Houston. So, Jo, email me, put in the subject line, lender in Houston, and I'll see if I can help you. Now, let us go into new homes. Okay, so let me update this. This new home data, I think, is really going to help educate a lot of people as to like what's really going on. At least that's my intent here. Now, the first thing I want to do is I want to talk about like what's the share of new homes. I've been hearing a lot of these bulls, and I appreciate that super chat. Really appreciate that, brother. Thank you so much. That means a lot to me. Definitely appreciate that token of love and support. Definitely. Now, the first thing I want to confront is, to the point of the bulls, they say, we don't have to look at new homes. New homes is just trash. It's only 10% of the market. But the reality is they don't know what they're talking about, and the data is not being reported. And I'm going to show you guys an actual appraisal as to where they're supposed to be removing the seller's concessions. Okay, so I'm gonna cover everything. But the first thing is I want to cover is it's not 10%. There's 32% of homes. So almost one third of homes for sale in the fourth quarter were newly built. That's record shy. I'm sorry, that's just shy of the record. So there's a tremendous amount of inventory from new home builds, and that makes sense because we have a lack of inventory from existing. So again, anyone that's saying, and we're going to go into the census data, and I'm going to show you guys that it says on the census data there's a lack of data reporting. But the first thing I want to kind of cover here is we're way above where we normally are. Yes, like around 2012 to say 2015, it was under 10%. Yeah, that's fine. But people are talking about where I'm circling. People are talking about this. You guys, it's 2024. We're not in 2020. We're not in 2012 and through 2016 right now. New home inventory is exploding at the seams. And if you want to know what's going to happen in the housing market, you got to watch what's going on with new homes. But they have 32% of market share for active listings right now. That's absolutely crazy, crazy, crazy stuff here, you guys. I don't know if you guys are feeling me on that. And then also this, you guys, take a look at this, okay? Again, to the bulls. So this is the census data. This is from this is from January 18th, okay? Here's what I want to explain to you. Because again, the bullish perspective is like, oh, Travis is wrong. Everything's reported on the Census Bureau. Everything's reported in the Census Bureau. But like the people that are saying this aren't even reading the Census Bureau, the notes. It says in the notes, don't think we have all the data. That's what the Census Bureau is saying. And I've highlighted the comment right here. So anyone that's saying that I'm wrong, that all of the data is reporting, please, you guys, please guide them gently because they're pretty hypersensitive, especially if they're bullish. Gently guide them to this right here. Okay, this says they are, however, still, and this is regarding the data, they are, however, still subject to non-sampling error. On average, the total quantity response rate for those estimates is 78.7%. We're missing over 20% of accurate data. It says right here, this isn't 100. This isn't in the 90s. This isn't even in the 80s. This is saying right here, you guys see it, 78.7%. We have a huge problem with the accountability and the lack of transparency with new homes. That's a fact, you guys. And not only that, okay, it says right here as well, this is not construction, this is sales. Even in the census data from the sales, it also warns you the data is tainted. The data is biased. They say it to us. And these people are still like, no, it's all there. It's not all there. These people that are saying this aren't thinking ahead. Here's what this says in the notes, okay? This is regarding the data for sales. They are subject to sampling variability as well as non-sampling error, including, and here's the thing, bias and variance from response, non-reporting, and under coverage. So the bears narrative that everything's being reported, I mean, my God, I mean, it's so hollow. It's saying it on the actual data. That drives me crazy. I really appreciate you guys throwing up super chats. I see that you guys threw that. Really appreciate that, James. Love you, man. Thank you for being a part of Vegas, my man Vegas as well. Vegas, I appreciate you for the $5. Great videos from the real estate convention in NYC. Look like a cross between Southern Rival and a cult. And you guys, if you want to see something like super crazy, watch my video that is saying, is this the end of realtors? I got a clip in there that It's like a cult. And if you guys don't think that I'm right about the cheerleading, go to that video and you'll see. And again, James, I really appreciate your support. I hope you're in Discord, James. Definitely appreciate everything you're doing. But again, you guys, there's a lack of data reporting and accountability in new home sales. This is not something we have to guess about. This is something that we know about. Now, moving right along for new homes, let's look at the median sales price because this is a huge indicator. Now, when we just look at year over year, okay, when we're looking at year over year, we're down for median, okay? We're down on median year over year, 13.82%. I'm going to make a separate video going into this because another bullish narrative is, oh, this is just down because of shrinkflation. But these guys with this bullish narrative aren't even looking at the data. This is not a result of shrinkflation. This is a result of hyper supply, excess supply, and unaffordability. It's not shrinkflation. In some situations, the homes are bigger. The homes are not smaller, they're in bigger in some situations. So I'm going to do a huge deep dive into that. So again, the prices, median sales price of new homes is down 13.82% for a total of $66,000. But here's a but. If you look at the peak, we peaked in October of 2022 at $496,800, which means we are down from the peak in October $83,000, which represents 16.8%. I think there's an issue with new home values. And the thing that I want you guys to really let's understand this is the fact that, let me see, where is it? The fact that this is way worse, okay? And I'm going to make a point by showing you this. The values are down more than 16.8%. And honestly, for average, okay, so if we look at the average sales price, I'll get to that in a minute, but the average, not median, average sales prices are down 14.3% year over year for $81,000. So whether you look at median or average, both of them are down double digits year over year. And again, what I'm saying is it's way worse than that because the builders are not disclosing seller concessions. Do you guys remember me saying that? This appraisal you're looking at where I'm circling with my mouse, this is the row for sellers concessions. When an appraiser appraises a property, they are supposed to remove seller concessions from the value, and they're not doing that. And I wanted to prove to you guys, again, here's the row. It says sell or financing concessions. You see this is comparable 1, it has none. You see this is comparable 2, it says FHA. You see that CC, that stands for closing costs. Closing costs $15,000. You see it says negative. See, it reduces negative $15,000 from the gross sales price here at the top. So they're missing, some of these transactions are missing $30,000, $40,000, $50,000 from sellers' concessions. This is a fact. We don't have to guess. But I wanted to show you guys behind the scenes, this is how this works. That's how I know about it. I look at appraisals all the time and they're missing the $30,000, $40,000, $50,000 rate buy downs. They are spending tens of thousands of dollars on rate buy downs. They are not reported here. But again, I wanted to show you guys that there is a spot for that. They're just not using it. But going back here, you guys, here's the average sales price. So we actually peaked on the average sales price 1 year ago. So from December 2022 to right now, average, like I said, average sales prices are down over 14% when we're looking at new homes. So we're seeing a huge crisis in new homes. Now, one of the reasons that is the supply. The supply for new homes, you guys, has been 6 months or greater since February, right here, since February of 2022. That means we have 2 years. So we've had 2 years of supply being over 6 months. Remember, over 6 months is a buyer's market. So 2 years, underreported data, it's probably double this, to be honest with you. But according to this data, we've been 6 months or more for 2 years. And that's one of the reasons why you're seeing prices plummet, absolutely tank when it comes to new home sales. Let's move on. Okay. Oh, this is a mortgage delinquency. I won't even go into this. I'm going to do a different video, but anyone that this is old. Okay, so I'm gonna just go back here for a minute. All right, let's go here, and we're gonna switch to our next. Do you guys like that so far? Can you comment bonkers below? Just hit bonkers below so I know that you're learning. I want to make sure that my lives are full of value and not just news articles, and that's why I put up the appraisal thing. Did you guys learn on that one? Did you guys see how that works? So they're supposed to reduce the value by whatever the seller's concessions are. Does that make sense to you guys? Just hit me with the bonkers if you don't mind. Please hit me with that bonkers just right in the face. Just smack me with the bonkers, you guys. I'm serious. Hit me with that bonkers if that makes sense. And not only that it makes sense, but that you guys learned. That's super important to me. Now we're going to go into our next video, and this is going to be our last video, this is going to go into the health of the consumer and the fact that, hey, consumers are running out of money, and that's a fact. So let me know.
Y Mellon's head of U.S. Macro, Sonia Meskin's here with us at Post 9. It's good to have you back, Sonia. Thank you for coming in. Today's a day where people are watching the bank weakness, some soft labor data, and wondering if that was a mistake, if they're doing a transitory all over again. What's your view?
Well, you know what? I think to some extent the Fed doesn't, in fact, know when they're going to go. And they are not necessarily averse to keeping the market in the dark as well, because it is unclear how the data will evolve on the inflation side and on the labor market side. It does look like the labor market is somewhat back to the conditions where we were in 2019, but it is still quite tight. And on the services side, inflation is still strong. So to us, it's actually quite understandable that they took March off the table.
I know you're not a bank analyst, but were your eyebrows raised when they took soundness off the statement?
They did an excellent job rolling out a very effective facility very quickly. That said, smaller regional banks are obviously still suffering. I don't think they're not acknowledging that. I think they're just saying the industry overall is fairly sound, and credit provision and reserves haven't been as adversely affected as was feared in March 2023.
Does the number of cuts and when they happen affect your market outlook for this year?
Yes, of course. But really, growth is also very important, right? If the employment and growth components hold up, then if they do fewer cuts against that background, risk assets might still hold up well.
Is that your view, that that's going to happen?
It's our central expectation, but of course, there are risks around that.
And how many cuts should we expect?
We do think the market got maybe a little bit too ahead of itself, pricing in 6 to 7 cuts at one point. It really remains to be seen how the inflation and employment holds up.
Was the behavior of the long end, we got 10-year 3.8 this morning, you're looking at December lows, is it implying fear of a mistake?
Potentially, yes, but also potentially weaker growth than was originally anticipated. That doesn't necessarily mean a recession. Could just mean weaker growth. And that balance between growth and inflation expectations is something that the Fed is going to be juggling with and struggling with this entire year.
So of the prints that they're going to get before their next chance to comment, what's most important? Is it still a mix of NFP and PCE, or do you think other things will come into the mix?
I think the geopolitical part is actually quite important as well, because think about those supply side issues that actually do feed through to inflation. We did have some very positive impulse from China, not on the growth side, but on the inflation side. They overproduced when they reopened. And if you look at the goods inflation trajectory over 2023, especially the second half, so the goods inflation that's been, weaker than expected. So now, again, we might have these supply side issues that might push up goods inflation or energy prices, and that's going to be a factor.
So less contribution to disinflation from China,
Potentially.
Red Sea issues, and then sort of incremental chop domestically on sequential inflation, right? That's why he was as, for lack of a better word, as hawkish as he was yesterday.
Yeah, I would say that, yeah.
What about growth? What's actually happening there? Because the macro data has been good. Even today's manufacturing numbers came in better than expected. And yet the messages from corporate America, I feel, have been a little more mixed, even on the consumer, with names like a Nike, for instance, warning about slower spending. So what do you think is actually happening?
Well, it's fair. On the one hand, consumers are running out of excess savings. On the other hand, the job market overall is still pretty strong. And I think the interesting dichotomy here is that the corporate America has been incrementally at least laying people off, whereas the government and also healthcare and some service-oriented areas has been hiring. On the infrastructure side, that's certainly been the case, right? So we don't have a lot of losses in construction jobs, in part because there is a government spending on infrastructure. So there's been a balancing off from fiscal even through today.
Finally, on the Treasury funding stuff, is that one incremental thing we need to worry less about or not?
But lower rates would probably help on that front, right? So telegraphing lower rates is probably helpful, even though the cuts haven't started yet.
Even though the cuts haven't even started yet. All right, guys, I'm going to do a quick community update real quick. I'm going to show you guys some things. I don't think I'm going to do the market analysis today because we're running out of time. I'll do that on Monday. Remember, I'm going to start doing lives Friday and Monday. So Monday, I'll do the market analysis because we went long today. But if you guys want up-to-date information, I'm going to do, again, Mondays and Fridays. I may switch to Tuesdays and Fridays to give us a little bit of space. But as of right now, Monday and Fridays, make sure you're here. So let's go into a quick, as they say, community update real quick. Now, one of the next videos I'm going to be doing here, and this is kind of Discord motivated, I'm going to go into like, okay, is demand really increasing? Is the prices really falling? And I'm going to read this article that has some really good key findings. And this is what they say. I'm going to just summarize this for you guys. After falling to a 28-year low in 2023, existing home sales will gradually rebound as mortgage rates decline. Now, bullet point number 2, with home prices holding on to their gains due to lack of supply, this is the important thing, and I want you guys to really think of what I'm saying. True price discovery will occur as lending rates fall and more homes are listed for sale. The market is so frozen and sideways and toxic and propped up right now, we don't even have the true price discovery. Listen to me. That's why I'm waiting. Well, I can't find a great deal. I'm looking every day for a great deal, but we don't even know what the price discovery is. We haven't even gone through that process because it's so frozen. Listen to what they're saying. Bullet point number 3, sales of newly built homes will hold their elevated market share due to builders' ability to buy down mortgage rates. That is not being reported in seller concessions. Last things this is saying is rents will stabilize due to added supply and more closely track inflation rates. So it's going to be a really good one. Now, real quick, here's the thing I'm not sure about, you guys. I put this post up here. Should I go to Eagle Pass, Texas? You guys throw me some comments below. Let me know if you guys think I should go. I had, let's see, almost 3,000 people voted. A lot of people said yes. 29% said no. That's a lot of people that I don't want to offend. So even though 71% said yes, I don't want to offend 29% of people because this is a very polarizing subject. A lot of people are telling me, oh, immigration is affecting home prices. I don't necessarily believe that at this point. But again, let me know in the comments below because I definitely at this point, I don't think I'm going to go because I don't want to offend people. I don't want us to go together. I just really feel like if I had boots on the ground and Eagle Pass this weekend, that would just be so epic, man. I mean, there's so many things I've never experienced in my life happening right now at Eagle Pass, Texas. So again, I think it would be so epic, but I don't want to divide our community. Maybe I'm a snowflake, Dean, but my nature is the opposite. I'm trying to be a snowflake, man. I'm getting older. I have children now. It's like, I can't just beat the world up anymore. I can't just fight the world. I mean, I can, but this right here, you guys, this is soy milk. I got no problem with it. Soy milk. Yummy, yummy, yummy. I got no problem with it. Let's move on, you guys. Now, a lot of people are like, what's the solution, Travis? You're just talking doom and gloom. You used to crash, bro. Blah, 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 blah. But I will have you know that what I have given back to our community is like enormous, you guys. I've made this free home buying class right here. This talks to you guys about what the solution is. So whether I'm right or whether I'm wrong, I've given you guys a pathway and the ability to empower yourself for free. And I got over 20 years of experience in real estate, realtor, loan officer, instructor, cheerleader myself. You guys, the solution is you. You are one of the solutions. You're the number one solution. Then obviously price, payment, location, those types of things. But I wanted to show you guys, right now I got 978 people that are taking this course. Okay. And again, this is free. I get nothing except a bill for this. I get email addresses, but I haven't emailed a single person. I get a bill. I pay money out of my pocket to have this up for you guys. And I also do this for myself. I want you to understand I'm doing this for myself as well, because I want to know that no matter what happens, I help to create a community where people can learn about purchasing power. People can learn about credit, income, assets, mortgage. Do you see this? We have a section summary, create homeownership goals, intro, payment, price, investor mindset, wedge basics, cash flow basics, what to ask a seller for, chapter review. Do you guys see what I'm trying to do here? I'm trying. Okay, I'm trying. And then also, you guys, if you want to know where any of my contact information is, I updated my About Me. So if you want to email me or join the Discord, just go to my description up here. You guys see I have a whole bunch of stuff linked now. I have X linked. I have an X account. I'm really trying to figure that out. Here's the Discord. You guys can join. Again, all of this is free. Here's our free home buying course. Here's my email. If you guys are interested in one-on-one consulting, I have that as well. Some people, the emails that they give me, there's no possible way I could take the time necessary to give them accurate responses. So if anything is important, got your one-on-one consulting. But again, you don't have to do that. Just go to the Discord. We have brilliant people there. So again, you guys, next Monday, I will be doing this. I will be doing a market analysis. We just ran out of time, sadly, today. So I will not be doing the analysis, and I will take some more Q&As from last week. And other than that, guys, I really hope you guys have a wonderful Friday. Thank you for joining me. Thank you for allowing me to guide you through this really, really toxic market. I really feel like, overall, here's the thing, and I'll be point blank with you. Is it a great time to buy a house? No, it's one of the worst times in histories to find a house. But are there special deals out there? Yeah. There are. It's just very, very rare to find a great deal. And that's why for the home buying course, I can find houses right now that have a great deal, but I got to go through 1,000 listings. So my point is, it depends on the situation, and it starts with you. You have to be able to low PE ratio, proper expectations. But the biggest thing, understand the process, understand how the data works. My home buying course will do that to you. Good luck out there. You guys are going to absolutely need it. I'm looking at the comments about Eagle Pass. Travis swims with shark infested waters. Eagle. She's got a point. I go in the middle of the night. I can't even see the waves that are coming and crushing me. I'm getting smashed around in my kayak, and I'm still running out a bloody shark bait in the middle of the night. So I think I got it. But again, I don't want to offend anyone, man. It's just, I want to go there for my own experience and to really capture how polarizing that is, but I don't want to do it at the expense of upsetting the people of this community. And I think that's fair. You call me snowflake, you call me soy boy, I don't care. This channel is for consumers that need education, consumers that desire empowerment. So you call me what you want. I'm going to lean to that. Now, when the camera's shut off, maybe I'm a little bit different, but when this camera's on, I'm a soy boy, crash bro, whatever you want to call me, call me. I don't care. I'm still going to stay here. I'm still going to report to you so long as you guys are listening and finding value. Now, love you guys so much. Have a great day. And other than that, if you're out there investing in real estate, you guys already know, I wish you luck. You will need it. Use the data, control your emotions, and I hope you win.